The ecosystem is in a very different place today. But through all this change, one thing that has remained constant is the conversation about, well, how are we going to deliver returns on the capital that we've taken in?
At the early stages of an ecosystem's journey, there's going to be a lot more capital coming in than going out.
The capital markets need to really catch up.
We have so many SMEs, millions of them, but then again, that's the problem, that they're all so small.
We should focus today on building those businesses to the scale where they will be the acquirers.
Hi everyone, good morning and welcome to the first edition of TechCabal Live Podcast. You'll meet the founders of our partners shortly, as they are the moderators of the conversation. Osarumen, Osamuyi and Derin Adebayo. And then we have our brilliant speakers, Tokunboh Ishmael, who is the managing partner at Alitheia Capital. We have Babacar Seck, who is the managing partner at Askya Investment Partners. And then we have Chirantan Patnaik, also known as CP, who is the director of venture capital at British International Investments. I'll hand over to Osarumen and Derin, who are the moderators of this chat, to continue the conversation. So over to you, Osarumen and Derin.
Hi, everyone. Good day. Thank you so much for taking the time to join us today. We've got a great conversation planned for you. When will the exits cross the road? Today's conversation is going to focus on one of the ecosystem's favorite subjects, but one that has become particularly salient since the funding downturn in 2023. Derin, please say hi.
Hi everyone, Derin here. Excited for today's conversation.
Thank you, Derin. Derin and I have spent a lot of time thinking and talking about the last decade in African tech. And we thought it was important to start this conversation with a perspective on where the ecosystem is coming from, where it is now, and perhaps where it's going. I took this photo 9 years ago at the weekend hangout at Hotels at NG. Derin worked there on the finance team. That's him in the red shirt. And I had just moved to Lagos as a reporter for TechCabal. Tech publications back then mostly covered gadgets and global tech announcements because most people didn't know or care what the local tech industry was building. So most of the conversations about technology in, say, Nigeria were happening at small meetups like this or on Radar, a forum that TechCabal used to manage back in the day. Actually, I think the archives should still be up on radar.techcabal.com. But something you frequently heard in those conversations is that one day we're going to disrupt, incumbents like InterSwitch and the banks. How things have changed. A few months before the photo was taken, Hotels at NG raised a $1.2 million Series A from Echo VC and Omidyar Network. It was one of the biggest rounds that year, made Hotels at NG one of the best funded startups on the continent. This was back when getting published on TechCrunch was a special event. But the ecosystem is in a very different place today. There have been over 42 $1 million plus rounds in 2025 already, and we're just in March. A $1 million round is no longer enough to get you published on TechCrunch or to get anybody to care, really. Back then, Hotels at NG at the time of their Series A, I believe, had 70,000 users, which was extremely impressive at the time. Today, Series A rounds, Series A user bases are typically measured more in millions or hundreds of thousands of users. More importantly, our companies are now impacting the economy, impacting life, impacting society, impacting government policy across the continent. In 2016 at TC, we did an event called Africa Beta. Most of the conversation was about how, we need a Stripe for Africa to enable our merchants to accept payments. It seemed like such an obvious thing. Since then, a Stripe for Africa has been built and acquired in Nigeria by Stripe. MoneyPoint and OPay have driven financial access to the last mile. The result of this is that I can be in Lagos traffic and buy chewing gum from a street vendor by making a bank transfer. This was extremely not the case 10 years ago. So the ecosystem is in a very different place today. But through all this change, one thing that has remained constant is the conversation about, well, how are we going to deliver returns on the capital that we've taken in, I guess, to implement this change across the market. Derin and I first wrote about this in 2021 in a piece titled "The Chicken or the Exit."
The core of that piece was this little chart here, and it looks at investments and exits in an ecosystem as a way to understand the maturity of that ecosystem. And there was one, I guess, major takeaway that we wanted to have the reader understand. And that was just, at the early stages of an ecosystem's journey, there's going to be a lot more capital coming in than going out. And so there's going to be more investments than exits. And it's for two main reasons, which are, a little obvious if you think about it. The first is that in the early years of an ecosystem, people are still experimenting. Venture capital is a relatively new asset class in the market. Founders are still trying to figure out what business models make sense for their local context. And so, with a lot of experimentation is going to come a lot of failure. And so it takes some time for people to understand, okay, what kinds of businesses can we build that make sense for our market, and how can we use venture capital to fund those businesses. And so, you spend a few years experimenting. I remember the experimentation phase in Africa looked a lot like taking business models from other markets and just copying them. And so we take, bookings.com and make one for Nigeria. We take Amazon and eBay and make one for Nigeria. And back then, they all had to be like .ng. So we had hotels.ng, cars.ng, drinks.ng, which were all just, in a sense, copies of like foreign business models. And so it took a while for us to say, look, let's build things that actually are tailored to our local reality. So that was kind of, the first couple years. And then eventually when you figure out the business models that make sense for your reality, then it just takes some time for those businesses to scale and, to be ready to exit. And so you have the average venture-backed company taking something like 8 to 10 years to grow to the scale where they eventually exit. And what is true for a single company is also true for an ecosystem at large. And so for the entire ecosystem, you're going to have a long period where capital is just coming in and the companies are scaling, and so nothing is coming out. But in that period, founders and investors and, people that like to talk about the ecosystem are going to be growing increasingly nervous about the lack of exits. And at some point, questions are going to start emerging around, how sustainable is this? And, does venture capital make sense in the ecosystem? Do we have to change things? And I think when we wrote that article, those conversations were happening really in depth in markets like Southeast Asia, India, and LATAM. And they were starting to happen in Africa. And we were saying, it's not quite time in the ecosystem's, journey. We were like, given that it's only, the African ecosystem was only about a decade old, we thought that it was too early to start having a conversation about the lack of exits on the continent. Since we wrote that article, a lot has happened in the African tech ecosystem. It's been 4 years and more than $12 billion has been raised. And that's a lot of time and a ton of capital. And so we wanted to, revisit that question and ask ourselves, is it still a valid justification to say, after all this time and all this capital, that, the maturity of an ecosystem is the reason why the level of exit activity is where it is, or, there's a lack of exit activity? And in order to answer that question, we think you have to look at things through the lens of venture capital cycles.
Venture capital is a cyclical asset class. Each cycle has 3 main phases. There's the run-up, where investment activity rises gradually over a period of time. There is the bubble or a peak, when that investment activity accelerates. Everybody gets excited and a bit overly optimistic. It feels like we have set course for the moon. And then there's the crash, which brings us back to earth, resets expectations, and keeps the ecosystem healthy. Now, the dirty secret of venture capital is that as an asset class, most of its overperformance comes from these brief periods of madness where you have inflated expectations, you have heightened deal activity, driving exit investments, I guess at rich valuations, and also enabling investment in critical infrastructure. In this chart, we've shown three of these cycles, I guess, for the US venture ecosystem over the past 25 years. Looking at Africa venture data since 2010, we can see that the continent has just gone through its first full cycle. It's a bit subjective to pinpoint the beginning of an ecosystem, but we picked 2010 because it was the first year that we could find reliable data on venture investments on the continent. By the way, if you're curious, the continent raised $35 million in 2010, which sounds ridiculous if you say it today. But we had the run up from 2010 to 2020. We had the bubble where that intense activity was concentrated between 2021 and 2022, and we had the crash in 2023.
So we've overlaid exit activity on the chart from the previous slide, and what we're showing is exits that were publicly disclosed, where the company's valuation at the time of exit was over $100 million. And the reason I say this is because I'm sure there were exits that might not have been publicly disclosed, or where the valuation might not have been disclosed, that might fit into this chart. But this was based on public disclosed information with publicly disclosed valuations. But we're showing this chart to illustrate two things. One is there's a clear sort of step change around 2019. And so in the 9 years from 2010 to 2018, there were just two exits, two major exits on the continent. And then in the 5 years from 2019 to 2023, there were 7 major exits. And the second thing you notice is that the exit activity is clustered around the bubble. So it's clustered around 2011 and 2021 and 2022. And that is because, as Osarumen mentioned, in these peaks where, there's a peak of inflated expectations and excitement, that typically is where you see exit activity ramp up. Of course, the companies that are exiting then are companies that were funded during the run-up, because the companies that are funded in the bubble are still, a little too early to really be having conversations about exits. So with that, I think it's helpful for us to look at the run-up period, to look at those companies and see what does that tell us about, the first phase, the first decade of venture capital on the continent. So if we zoom in on the period from 2010 to 2017, and we stopped the count at 2017 for two reasons. First is just it was roughly 7 years ago, so that gives enough time for those companies to have scaled and for a number of them to have exited, and maybe some failed, but it gives enough time to be able to look back at exit activity. The second reason we stopped at 2017 is because 2018 was actually a meaningful inflection point in the ecosystem's journey. And so every year before 2018, African startups as a whole raised less than $1 billion in venture capital. Every year after 2018, African startups as a whole raised more than $1 billion in venture capital. So if we just focus on 2010 to 2017, the continent saw $2.4 billion in venture flow into it. We thought it'd be interesting to see what that capital has returned. The answer is 2.5 billion in cash. And so of the nearly 600 companies that were funded from 2010 to 2017, just 5 of them have returned all the capital that flowed in. So I'll pause and let that sink in. 2.4 billion flowed in, 5 companies have returned 2.5 billion. And this isn't even taking into consideration all the unrealized gains, right? So we've had, 3 unicorns that were founded in that time period. And as a whole, they're now valued at something like 6.2 billion. And you might have, thoughts about these valuations. They're a few years old. They came during the, the height of the bubble. But still, the bottom line is kind of, we've had all these companies funded 5 of them in that period, 5 of them have returned all the capital, and then there are hundreds of them that continue to scale and continue to be valued, as a whole in the billions. So I think if you think of VC in that period, as just a single fund, we've returned the fund, and we still have, a long way to go. Now, I know what most people are thinking, and that is, well, Derin, African VC did not end in 2017. Since 2017, African startups have raised roughly 20 billion. And, while we kind of returned the first 2 point something billion we raised in the first decade, returning 20 billion is a completely different thing. And so that is kind of where we sit today. And that's the conversation we want to have. What have we learned? We've gone through this journey, the run up, the peak, the crash. What have we learned from that first 2-ish decades of venture on the continent? And what does the future hold as we try to navigate and work through the madness of the past 5 years, and which lessons are we taking into the future? So that's the conversation we want to have. We will pause here because we being Osarumen and I want to speak less and listen to the very impressive, accomplished panel we've brought today. And so, Osarumen, we can take the slides down and start the conversation.
Thank you so much, Derin. That's certainly the conversation we want to have. We have, it's interesting sitting down in your high tower and thinking about the ecosystem and then coming once every few years to say, here's what's happening. I think the much more important conversation to have involves people who have spent the past decade investing on the continent and actually have skin in the game. We're going to start the conversation by reflecting on what has happened in the past decade. We've given our take on the story of African tech in the last decade, but CP, if you can please kick us off, from your experience at BII, you've invested both in funds and in companies directly. What's the story of the last decade in African tech? What have we learned?
Yeah, sure. Thank you. Thanks, everyone. And actually, pretty interesting fact points that you had of how you contrasted what I would call phases in African tech. So, great set of data to kick this off with. So, just for context, as BII, we have been investing in the region for quite some time, way back, and not just in venture capital, but in private equity, SME, infrastructure. And I think it's very important to contextualize that, because as kind of each ecosystem goes through that particular cycle, you have to understand where it starts from. So we've been a large investor in China, decades ago, in LATAM, and still continue to look at India. And in each of these markets, right, there have been trigger points. There have been kind of aspects where there has been funding, but then something kind of takes it away to the next level. I think if you look at China, clearly the whole consumer class growing, booming, but also domestic capital flowing in, provided a lot of investment activity, but also, so you had a lot of renminbi funds backing local VC companies, and then also providing exits, and that kind of led to a lot of churn in the whole capital cycle, and then that's how you got global investors in. And then you look at India, something similar around mostly the BPO boom, the software exports, but also a lot of local aspects. And I think the one contrast I would like to think when we think about Africa is, the domestic markets, the capital markets need to really catch up as well. And so, as BII, we obviously, from a UK development standpoint, invest in these markets. When you have people on the ground, we've been investing in markets for a very long time and consider ourselves local, so to speak. But you need to have local capital come in. And let me contrast that by, when we look at India, for example, there have been quite a few VC-backed exits in that place. And I think we've had more than about 160 VC-backed companies that have gone public. The total market cap of those are about 160 billion. So that's a very, very large kind of data point if you're an investor coming in. But again, that's domestic capital driving quite a bit of that. So in Africa, I think when you look at 10 years, I think close to about 20 billion invested, and 70% of that happened over the last 3 years. So I would still say that's still a bit recent. I mean, it takes about 10 years for any company to, from seed to IPO, to get there. So we're still early. The exits that you're seeing, the markups that you're seeing are still not, what I'd call, bubble territory that you see in the US. So it's not bad. And I think one aspect we should be very proud about is that the ones who had actually made a lot of money from the unicorns exits are actually local African seed funds. So if you peel back the layer, it's not your Accel, Sequoias, and global folks that are coming in and taking away the alpha, so to speak, from Africa. It is local capital, or local angels across. So people are starting to kind of see that, and that's a good thing. I do think that we will need to have a conversation, and as this conversation goes on, as to what do you think, what should we all think about what is a scalable company in Africa? Because if you take aside fintech, which broadly crosses borders, there are other segments which do not cross borders. And is that okay? Is that something which somebody can actually price and scale and say this is an M&A exit, this is an IPO exit? We need to think a bit hard about that. But yeah, happy to dive into and hear more from my fellow panelists.
Thank you so much, CP. That was a thoughtful response, and you've preempted a few of the questions I was going to ask. So thank you for setting the stage for us. I'd love to move to Tokunboh because, as CP mentioned, our local capital markets are relatively shallow. There is one exception to that rule, which is South Africa. And Alitheia Capital has invested or does invest, I guess, across these markets, with the Alitheia Capital, Alitheia IDF fund targeting Nigeria, South Africa, Ghana, Zambia. Tokunboh, can you please speak to your experience across these markets, and also, I guess, how, from the story you've learned in the past decade, how you think about, I guess, the exits question?
Yeah, thank you. And I agree with what Chiran said earlier about strengthening local capital markets. But I'll go one step further there, that we do need to think about the delayering of the capital markets to have specific windows for the VC-backed type companies. And we have that in other jurisdictions. Even South Africa has you call it a lower tier exchange for these types of companies. So we need to see some of that delayering happening for the local capital markets to be meaningful. It can't be in the same capital markets that we have, the large cap and the banks, which in itself is already not even deep enough and is not well capitalized enough for those companies. Talk less about having companies that people still need to see them scale, and they're still nascent and they still need the support. And the cost of being on a regular exchange is significantly higher than what a VC type back company is able to bear at the stage at which they're coming to the market. But even before we get to the markets, what needs to happen across Africa is a more broadening of the buyer pool. We need to see more consolidations within sectors, more roll-ups. We need to see more activity between financial buyers and some of the strategics. What we have, I think there was an Economist article a few weeks ago about how we have so many SMEs, millions of them, but then again, that's the problem. They're all so small, and we're not thinking enough about the consolidation. So there needs to be some activity happening more around expanding the buyer pool, having roll-ups for sector consolidation. We're still early in the journey. And here we're talking about VC, but even in private equity, which is the next step up, which ideally should be that pool of capital that's providing some of the exit for the earlier funds. Even there, we're finding challenges because same issues. The capital markets are not deep enough. We haven't put in the supporting systems. We need to focus more on value creation within the businesses so that they can scale and be attractive to other buyers, financial and strategic, and regulatory support also. Even Nigeria, South Africa, Kenya, regulatory support for the ability for business combinations that are not hindered by esoteric policies about business combinations. But beyond that, there's the elephant in the room, which is the macro. Okay, so with the macro backdrop, particularly in a country like Nigeria, is not great. You have significant foreign currency, local currency depreciation. Many of the funds are dollar denominated, even though many of the funds are locally placed and working, and you have the local ecosystem. The funds are typically dollar denominated. So there's a player and story for maybe naira denominated funds that are immune. But again, in the VC world, how well will that work given the cost that some of the VC firms, we're still importing some tech. We have a lot of tech development on ground, but we're still importing tech, and that's talent and hardware, etc. So the macro plays its role. The interest rate environment, all related to the currency as well, that all plays a role. So we need some of the regulatory policies that bring some stability around that, so that the businesses themselves can focus on their operational efficiency, diversification of revenues. At Alitheia, it's a key thing for us when we talk about value creation. How do we diversify your revenue base such that we're diversifying your currency income, and we're driving down on the costs so that you can be attractive to a financial buyer, a strategic buyer, and even be positioned to think about the stock markets. So innovation is key across the whole ecosystem. I was smiling when you were talking about ecosystem, because with that word, there's a tendency to think that we're thinking of the VC ecosystem alone. But actually, the banks, the financial advisors, the lawyers, as I've talked about, the capital markets, the regulatory environment, there needs to be innovation across the whole spectrum. So I'll pause there for now, and happy to delve in deeper later.
Thank you so much, Tokunboh. The question that kept ringing in my mind while you were speaking is, like, how does one solve such a multi-dimensional problem? How does one, for example, coordinate with the government? How does one coordinate with different private sector players? Do you have any thoughts about how we might operationalize this?
Yeah. So, I mean, I feel a bit long in the tooth when we talk about coordinating on regulation, because I was one of the people in the room when we started writing the mobile money policies that enabled the first fintechs like Paga, who hasn't been mentioned here, but has been steadily, chewing its own elephant and scaling and re-engineering to adopt in the marketplace. So my experience has been that going as one company obviously doesn't work, or one VC or one investor doesn't work. So strengthening also the industry organizations that are able to come together with cogent recommendations. But again, we've spent a lot of time writing recommendations to government, and my prayer is that with some of the newer blood that we're seeing in the relevant agencies and commissions are beginning to listen to some of those recommendations. But there's some low-hanging fruit, because we've been talking about NGX at the stock exchange forever, but there's stumbling blocks, and we need to remove some of the cost stumbling blocks. We need to remove some of the requirements that make it easier to even get some kind of introduction onto the exchange, which plays a role. We need to have innovative instruments in those areas as well. So whether it's in redeemables or whether it's even enabling some kind of the kinds of bonds that smaller companies can bring to market without the same stringent collateral requirements on corporate bonds and the ratings and stuff. So that's all part of the ecosystem, but it really is coming together to go with policies, and many policies have been written their tombs, and we just need to begin to execute on some of those.
Thank you so much, Tokunboh. The two responses highlight a tension that I love, I guess, to explore with Babacar. So, CP raised the question of what is a scalable African tech company. At the point of investment, everybody's of the opinion that the particular company they're investing in or that they're building is a scalable African tech company, and the valuations tend to reflect that. And so when it comes time to have a conversation about consolidation, something you find is that acquirers and target companies don't always see eye to eye on what the different businesses are valued. Babacar, first of all, do you have any reflections on the past decade in the ecosystem? And two, I guess, how do we resolve this challenge? The fact that many of the companies that should be rolled up are currently valued at, say $30+ million.
Yes, thanks a lot, Osarumen. And I want to thank TechCabal, yourself, and Derin also for organizing this very insightful discussion. I think I'll say two things. First, if we look back at some of the data you showed and what we've seen in the ecosystem, I think it was very interesting. You looked at the 2014 data to look at exits. What was the state of exits in 2014 when these companies were founded? We had no VC exits on the continent. And now, as you've showed, we have more than $1 billion in actual cash that has been returned. And in addition to that, several billion in value. And, if we look at what the average holding period for a company to get built, like Chirantan has mentioned earlier, I think it would be harsh on the Africa ecosystem to say today that, we are not delivering venture type returns. I think one thing we've learned in the past decade is that not only, it is possible in Africa to build great businesses within a decade, but that also those businesses can generate venture scale returns and significant impact in terms of job creation, in terms of economic value added on the continent. So for me, the main learning of the past decade is that, and I think we should not just look at cash returns because if you actually let's just look at 2015, 2017. There was around $1 billion, $1.2 billion that was raised back then. Which companies were created in those times, and how much are they worth today? There was MoneyPoint in 2015 that's worth $1 billion. Paystack 2016, 200 million. Flutterwave 2016, 3 billion. Andela 2014, 1.5 billion. OPay 2018, 3 billion, and I can keep going on. There's more than 10 billion in value that has been created from that capital that was invested. So Africa is delivering the returns. The returns are not yet cash, but the value has been created, and it's here on the continent. And so I think that's a very important point, which leads me to the second thing I wanted to say, is with regards to exit. Today, we do not have so many M&A and IPOs. But if we look at markets that are more mature, I'm thinking about the US more specifically, 70% of exits happen through M&A. But who acquires those businesses? It's big tech. It's not the most traditional businesses that do the most of the acquisitions. The vast majority is actually done by tech companies. And I would argue that we should focus today on building those businesses to the scale where they will be the acquirers, rather than focusing on the short-term acquisitions, because that's how we will drive long-term value for the investors in those businesses and for the economy. And that's how we will build those businesses that become the platforms to acquire tomorrow's businesses and create, the virtuous cycle of innovation, growth, and acquisition. So for me, the solution is in the future, but it's also in focusing on businesses that are fundamentally good companies, because we have had this bubble, which during a couple of years, and there were big arguments in the industry, and I won't name names, but some people were that convinced that GMV was a very good way of valuing companies. Um, you know, I come from the corporate space before and private equity. You have to think about who's your buyer in the end. Investing is about paying, creating value, and then selling. If you're exiting to investors an African business, you're likely going to be valued somewhere between 5 to 8 times EBITDA. So what really matters is building businesses that have very strong fundamentals. Now, there are the financial fundamentals and the non-financial. The financial fundamentals is EBITDA and cash flow and growth. That's what matters. And then the non-financial fundamentals are governance, is around the quality of your teams, the quality of your process and operations. And very importantly, a topic that I think would deserve more attention is building a coherent equity story. Some businesses now, we're hearing a lot these days, oh, Africa to LATAM, Africa to Asia. I'm like, okay, sure. This is top line, maybe bottom line. But, what is this business about? What are the synergies between having your business, I don't know, in Tanzania and Mexico? Like, is that something that creates more value, or is just a very opportunistic move that doesn't have synergies in the business, and then makes it really hard to either IPO or do an M&A? And so, yeah, so I will stop there, but I think for me, that's what we should really be focused on, creating value. And as a result, that means the exits in the foreseeable short to medium term future are going to come more from secondaries. And if we just look at transactions above $25 million since 2019, we have had 125 such transactions, which generally include a portion of secondaries. I've seen anywhere from 10% to 50%, and in one case, 100% of secondaries, which has been counted in capital raised, which it is not. And that's about 8 billion in deals. If you take 10 to 50% in secondaries, that's $1 billion to $4 billion of capital that has been returned potentially. And so I think that's where we should focus our energy and building good businesses.
Can I?
Yes.
So I agree with Babacar about the focus on secondaries. I agree about the focus on value creation and not cash per se. And these are arguments that actually I talk about to a number of people, including some investors. The fact of the matter is, for us to get cash coming into the continent and into the key countries, we need to show liquidity. We need to show cash. That's what people. If you're fundraising at the moment as an investor, let's put aside as a tech company or a VC play. Everyone wants to see the cash that you have returned. And so, yes, indeed, secondaries can play a role there. But what you're also finding is that with some of those secondary opportunities, I mean, Moneypoint was great because lots of secondaries came in and took out some of the primary, the initial investors, not all of their money. So those that had some of a return, that's great. It shows something. But the investors in the funds want to see their cash returned. There's a focus on DPI, and you can't get to DPI unless you return cash. So I think secondaries are great if they can provide that. What you find is that there's a lot of choke on secondaries, where the secondary will say, yeah, okay, maybe I'll take 10%. Where the next investor coming on will say, maybe I'll take 10%. And that is not enough cash for the fund manager who's trying to get cash back. So we need to, it's one of the levers that we need to pull alongside the others that I mentioned, deepening the stock markets, roll-ups, consolidations, and roll-ups not just because we need to just create these bigger and bigger platforms, but also roll-ups for efficiencies, because we have lots of small businesses that are replicating some efforts, and actually they can come together and build bigger platforms. So I agree with you. I think that then secondaries is one of them. The other is maybe even with the redeemable instruments. But the key thing is that it as you've mentioned, VC private equity, it's a value chain, it's a food chain, and everybody needs to pay the next person up. And so yeah, we need that liquidity to happen through value creation and also cash.
Thank you so much, Tokunboh. You preempted my comment and question for Babacar, but I think it's a great place to pivot to CP. So one of the implications of focusing on long-term value creation is that maybe VC funds, we should assume that their life cycles are going to be longer. CP, how do you feel about that as an LP?
I think no, this is a very, very interesting point, and I think patience in this asset class is actually by design, and I think a lot of people kind of don't appreciate that, and I'm also conscious that most institutions that are investing in it all come from a very different kind of context, right? Because a large part of dollars and commitments of LPs are either in private equity funds, infrastructure funds, which generally are shorter in terms of their cycle. If you look at data, even globally, and I'm talking top decile VC funds, they take 15 years to return, right? Like 8 to 12 is just not happening. So, but I know that's what it says on the tin, but it's not going to happen, right? But does that mean we just keep pushing it and saying no, we need to think about it? No, I think there's a discipline aspect to this as whole point. So I think it's baked in, but patience does kind of run thin when LPs kind of start to have this whole build up of commitments for quite a few vintages and still nothing is moving. So we can't. There needs to be a point of saying, okay, we've done one fund, we've done second, where are things moving? And that question will come up the next time we do it. I think the one good way to think about it is if you're a recurring LP in a fund, the way to think about, if you're in fund 3, for example, like, can I actually sell fund 1 as a secondary? Can I price it? And that should give you a good understanding of track record, and it's a much more real argument. So secondaries is a way. We've kind of attempted that across this asset class, both in Asia and in Africa. Uh, that is a way to kind of drive returns, but also a way to mobilize capital for people who want it. But I just want to caveat one thing. Secondaries, even globally, is probably only 10% of the total primary dry powder raised for investment into VCs. So it's not a full takeout mechanism. Um, and the other thing to understand about secondaries as a product is that the reason it's liked, because it contains de-risked assets, right? It can, you're well beyond your J curve. And so we should not kind of go in thinking, seed fund, even early stage, that things are de-risked and we can, pass it on as a secondary, because there's still a lot to do in them. But I think Tokunboh raised a very, very interesting point that the private equity SME segment also has to develop. And I think the way I think about it is there's this whole conveyor belt of capital, which in some markets is perfectly there. So you have angels, incubators, VC funds, private equity, et cetera, and growth buyout. So everyone kind of picks up from somewhere. I think we're missing something here. So we have a very, very vibrant VC ecosystem in Africa. Some of the smartest people running great firms, great founders. And VCs, the way we look at an early stage fund is that you just need to back good companies. Founders will figure it out. Sure, you can add a bit of value, but that's not really your role. The real role of a private equity investor is to focus on some of the hard stuff, some of the more mundane kind of aspects around growth, etc. That's missing. And I think we need to be conscious as funders of this ecosystem to also continue to back this, because I don't think one should expect VC to carry the whole burden of what we need to do tech in Africa, right? It needs to be taken up by large private equity groups as well. So again, I wanted to also repeat is that yes, exits are not there, but it takes time. But also we can't just be putting all the attention on let's say Babacar's here as a GP, so you shouldn't be carrying all the weight on your shoulders.
Thank you so much, CP. One of the key parts of this value chain or this food chain is large, perhaps technology forward or technology enabled companies acquiring smaller ones. Something that's been surprising, reflecting on the past decade in African tech, is that African, but let me specifically say Nigerian, big banks, for example, are not very acquisitive. I would have expected, for example, a business of the size of an Access Bank or an FCMB to be acquiring, even if it's $1 million valued startups, to plug specific, gaps in their product suite or in their business. But we see that they often prefer to try to build it themselves. So Tokunboh, I'm curious. One, why do you think this is happening? And two, again, how do we fix the conveyor belt?
Yeah, well, why is it happening? The fact is, the banks feel that the banks have the deep pockets and feel that they have the technical know-how to build out. I sit on the board of one of the banks that you mentioned, and when you survey what's out there and you look at the price that the owner of a tech might be thinking of, then you think, well, actually, I may need to build this myself, but I also may need to build it myself because I have a unique tech infrastructure that platform may not have been built for. But if I look at it from the other side of the, let's call them the Davids, so David and Goliath, the Davids, do you really want to be bought so early on, 1 million valuation, and then have your innovation stifled? So I'm not necessarily a proponent of buying so early from such a large bank, but maybe there's um, a larger similar tech platform that you can roll up with and consolidate. That's where I feel some roll up can happen, and you can get economies of scale, efficiencies, and talent. And you're not reliant on the one single founder. Where you can build proper teams. So why isn't it happening from the bank side? I mean, there are a myriad of factors. Some of that being some of the technology isn't sufficiently baked, or some of it is overvalued before it can come in.
Thank you so much. My bosses at TechCabal have informed me that I guess we need to pay attention to the clock, and so I have one final question before we move on to the presentation about the TechCabal Insights Exits dashboard. So when we look at the companies that were or the capital that came in between 2018 and 2023, a significant chunk of that capital went to 100 million plus growth stage rounds. And a lot of this conversation is actually about what's going to happen with that capital specifically. If those companies were to try to list on international markets, they would need to have business models that are familiar, at least based on what we've seen so far. They would also be considered small cap companies because of their current size. But as we've said in this conversation, local markets are maybe a little bit too shallow and are not fit for purpose for those businesses. Babacar, do you have any reflections to share on, just as we wrap up, on what will happen with those businesses specifically, or what interventions need to be built for scale-ups currently who have taken in growth stage rounds to see exits in the coming years?
Yeah. Now that's I feel the weight on the shoulders. I, I
Okay, we can
I
share
think
it.
it's
Everybody will get to share.
I think it's an important question. Earlier in the discussion, I think Derin mentioned how some companies' valuations, are maybe still valid or maybe not valid. And that the question is, what do you do with that capital? The capital efficiency is one of the key features that we look for in startups that we back. And capital efficiency is about how much value does the capital you put in generate post the investment. And I think that's the first thing that those businesses need to focus on, because if you raised 100 $200 million at $1 billion valuation, investors are looking for a multiple of that in terms of value creation. So you should be looking at $3 4 billion in valuation down the road, which at that scale becomes much harder to generate, because it may mean entering new markets, entering new product verticals. And it's a story about continuing to create value beyond that $1 billion. And I think at where those companies are today, many of them are single country fintechs. So it's about entering new markets with different regulation, different setup. If we think about whether merchant payments or mobile money, is it bank led or is it telco led markets? So it's not the same type of competition. And so it's extremely difficult decisions that have to be taken. And as CP mentioned, that's where private equity and strategics can provide the value. And so it's really important for those businesses to have the right kind of shareholders and partnerships in order to be able to deliver that value. So I'd say that's the first thing. And second, equity story becomes all the more important, and hitting the right metrics. When you're thinking about exit on an exchange, at that stage, different, like currently it's going to be London or the US or dual listing in Africa. You need to hit $500 million revenue, $200 million revenue, a certain growth rate. You will get benchmarked globally, and you will get severely discounted as an African business. The multiples you can fetch for similar numbers between an African and a US business are just not comparable. If we think about CloudStream, which is currently doing its IPO, they're doing 1.9 billion in revenue and raising at a $30 billion valuation. That's not applicable to African startups. And so that's why also the valuation of those growth rounds need to make sense, because exit will be challenging. So for me, that's the two things I'd focus on: the equity story, the key metrics, and making sure the business remains very capital efficient.
Thank you so much, Babacar. That's definitely reflected in the research that Derin and I did of the companies that of the exits that we showed. All of those companies were acquired for less than $1 billion, and I believe, with the exception of InstaDeep, they all raised less than $100 million. Tokunboh, do you have any reflections to share as we close out on I guess how we can engineer success or exits for those companies?
I mean, I think we've touched upon many factors. We started with talking about broadening and deepening the capital markets to be more accessible for the smaller companies. There's a whole discussion that can be had about that. But even within that, we've spoken about from creating value within the companies, from thinking about innovative forms of getting liquidity for the companies, secondaries, we've already spoken about that. It's one form. So for me, it's we have a toolbox, and we need to pick on different tools within the box. And I think that overarching it is, as we think about how we make the environment a better business environment, and we think about our local capital markets, and we think about our local fund managers, we need to see more domestic capital from big asset allocators, because that brings more cash into the market, that brings more cash that can go into the funds that make investments, that brings more cash that helps the ecosystem thrive, that brings more interest from the advisors, the bankers, the lawyers, because we need all hands on deck, and we need the different parts to play. But a big missing part is domestic capital, because much of what holds us back As a fund manager, for example, when you're looking at the valuation to think about, can you sell now, can you not, has the company grown enough? You're also looking at that in terms of whether it's local currency returns versus US dollar returns. And the local currency returns invariably is usually significantly higher. And then you're thinking, well, I need to hold a bit more because the USD return isn't quite there. If we had more depth in our local capital with the domestic capital, that could help release the strains, some of the strain at least.
Thank you so much, Tokunboh. CP, any final words?
No, I think we're obviously long-term investors in the region. Really understand the opportunity there. I think the interesting side that we get to also see is we talk a lot about private capital mobilization at BII. So how do we get people from the US, people from other markets in, and it's very interesting. What do you sell them? Do you sell the region? Like, do you sell, let's say, Nigeria? Look at Nigeria; it's such a vibrant market, or Egypt or South Africa, or do you sell the company, which is fast growing? And that always is a very, very interesting dynamic, especially as companies look to exits, whether for IPOs outside or with a global buyer. So I think nailing that, which is it's actually a great company growing really, really fast despite the macro. Don't worry about all that. That's quite important. I just wanted to mention, there was a company which recently listed in Nasdaq called Kaspi. It's a large company from Kazakhstan. It's a small market, but raised $1 billion. It is just playing on that. It's not playing on some kind of regional expansion. So, and there are kind of lots of other aspects to learn from such stories out there. So I think, long-term positive, but it's our job always to keep this momentum going in the ecosystem. So long-term optimists here.
Thank you so much, CP, and thank you to all of the brilliant panelists, I guess, who have made this an amazing conversation. We've heard we need patience. We need to focus on the fundamentals. We need to fix the conveyor belt, if I can put it that way. Up next, what barriers to securities exchanges, e.g. NGX, remove to accommodate VC-backed companies? I believe Tokunboh spoke specifically to this as well. But do you mind giving us some additional color? I'd love to make a list and maybe we can publish something about it later on specific interventions by the NGX.
I mean, I think I've mentioned most of them. Simplifying the listing requirements. For an introduction on, say, the NGX, it doesn't need to be the same as the main capital markets. And if you're trying to drive for innovation, you can think about how you simplify things like the ratings, the collateral. There could be financial incentives as well to some of the smaller companies. We have more companies that could list in on the exchanges, probably from the real sector. They shy away. Maybe they need some more incentives to get the markets a bit more vibrant. We could educate both listers and the general populace about engaging with the capital markets. We can improve access to the capital markets, like I mentioned, with the domestic capital. If we see more domestic capital coming into the exchanges around the introductory side, we can see more happen. Again, with technology, we're talking, maybe there's a VC play that comes out of this. We need to see more technology use across the exchanges that makes it possible to actually reduce the cost for some of these smaller entities. We need regulation that supports that, and maybe even have some sector-specific entities or vehicles where we can see some consolidation. So all in all, we need to strengthen lister confidence, investor confidence, general market confidence. We need to deepen the markets. But that also goes hand in hand with everything we've said earlier. And I just have one last point actually relating to what CP said about a company in India. Well, I mean, India is the whole of Africa. So, and we don't have one exchange. So maybe if we had one exchange, you can talk about size of capital markets, size of population. So our companies do have to think about regional expansions because they don't have the one country, one language, one currency, one stable currency. And so while I like that analogy for a company that needs to focus on fundamentals, and all companies have to focus on fundamentals, the context in Africa with our fragmented nature requires some innovation to solve for our peculiar challenges.
If I
Thank you so
may
much. Oh, yes, please.
bounce on that answer, one thing we noticed last year was there was a very strong, correlation or link between the increase in stock price and the exposure to francophone region in particular, but generally to rest of Africa in Nigerian
Yep.
companies. And I believe one thing that has not been done yet in the African tech ecosystem is building true regional players. And I'm thinking, especially across West Africa, where we have very strong pre existing economic links, we have not yet seen startups from Nigeria enter Francophone, startups from Francophone enter or partner with Nigerian startups. And I think there's a lot of value that can be unlocked there because that will significantly de risk the macroeconomic profile of those businesses and make them more attractive, not only to local but also to global investors because they will be more resilient. And that's one
Indeed.
thing, at least we're exploring on our side, but I think the market generally should dig deeper into.
Indeed.
Do you think the biggest barriers to this happening are currently political, cultural, or something else?
They're not.
I think, sorry,
Go
go
ahead,
on.
Tokunboh.
No, I was going to say it needs another podcast. It's going to take a whole hour on this topic alone, but please go ahead, Babacar.
I was going to say, I don't think it's political. I think there's some cultural aspect to it, but that can be overcome. I have an icebreaker that's about jollof rice and chep, which I've developed over years. I'm sure other people can find other things to connect across the region. No, I think more seriously, it's also about knowledge, know-how. If you fintech is what has scaled so far. If you want to answer the YMU region, you speak to the YMU central bank. You need to speak French. You need to engage with the highest level stakeholders. You need to engage with ministers. You need to engage with regulators. Your teams need to be carefully selected, and it's not straightforward. There's no playbook as of today. The ones that have done it successfully are the banks, especially players like UBA that have been very forthcoming in that space. But it's a very long-term engagement, and you have to make it a priority. And until now, what I have seen is, which I think is not the best value creation, at least, is going like Nigerian startups or Kenyan startups going to each other's market where the linkage is much less obvious. It's not the same region. We saw what happened when Nigerian fintechs went to Kenya. They were not helped. And so I think actually focusing on markets that are closer geographically can be an edge, but you need a partner to do that. You can't do it alone.
Yep.
Thank you so much, Babacar. Reflecting on the past decade of the ecosystem, something that kept coming up for Derin and I is that the capital that came in invested in infrastructure that should enable the next, I guess, wave of outcomes. The story that a lot of us used to think about the opportunity on the continent in the past decade involved population growth, involved rapid urbanization, involved smartphone penetration. I think it's probably safe to say on this call that we can put that story to rest. Let me know if you disagree. But one thing we're really curious about is, well, where do you have conviction today? Why do you believe that we will build much more valuable ventures in 10 years than we're building today? And what are you underwriting? If we could start with CP.
No, thank you. I think I think what we are underwriting is that you will tend to have quite a few moats, surprisingly. And if if you listen to something like what Ifosa Ojomo, who's a very well-known writer and kind of observer, he says that you don't in Africa you don't just build the company, right? You also have to build the road and buildings around the company to reach that business. So when you start to do that, you start to build the entire infrastructure around it, and that becomes quite valuable. This is not the same in other markets, and I think that's a very, very important distinction here, because in other markets it's very easy to replicate, and we're seeing that in, if you look at the US, kind of whether it's AI or software, it's easy. It's like, you can just start something there, but to build something substantial takes, you tend to build a moat. And I think people who identify that right up front, the fintechs have done it, some of the successful names. You'll start to see a lot of mobility companies doing it. E-commerce in some ways did it for a while. So, you'll start to build very, very substantial moats. And I think that's the strength of most of the founders that we see. It's a very uh, build from the ground up. We see that in other markets as well, other emerging markets. So that's why we're excited. I think earlier we used to think this whole thing about expansion, and expansion keeps getting brought up. It's not as natural, I think, as Babacar also mentioned. It's not as natural, and maybe that's fine, because even if you look at take Europe for example, it's not a single market. They're very, very different kind of cliques and differences, and it's just that those individual markets are large in itself. And so people building these regional champions actually could be quite interesting. That's what we're excited about. That's what we get excited about when we back on the fund side, backing kind of local managers who are very, very focused on particular kind of aspects, but also then companies you know, who may want to expand but are extremely well penetrated in that particular market. We think they have a right to win, and I think that's kind of played out.
You suffer for 8 years and then get the right to be a monopoly. In summary, Tokunboh, do you have any reflections?
I mean, if I want to come in on that, when you think about, and indeed, all our companies, you have to backward integrate, build that infrastructure, and then half your money's gone, and then you haven't quite reached where you need to scale to, and then we're asking them for liquidity. So we need actually also the governments to step in and build the right infrastructure and put in the right infrastructure that makes ease of doing business better. So yeah, you can build all of that, but again, for me, all hands on deck. You need to come together. For us, we also focus on the markets and the essential goods and services. It's a key part of what we do, because then we know that we're not just focusing on addressing the 1% of the market, but we're addressing a larger market when we think about ordinary things. So we're not just in tech, we think about food, ordinary food and beverage that the masses require. Financial services is a key part of what we do, leveraging technology in that, leveraging efficiencies and economies in scale in manufacturing and agribusiness. That's very important to us. Looking at share of wallet for essential goods. So whether that's health, education, and the financial services. So for us, those are areas where we feel that if you're building products and services in non-discretionary aspects of the wallet, you can also build a kind of moat around you, or unique selling proposition to scale.
Thank you so much, Tokunboh. Babacar?
Yes. It's an interesting question, because also you're asking for the next decade, and the word keeps moving. I could tell you stablecoin, but I don't know if it's still going to be around in 5 years. So for us, we try to focus on two things. First, of course, is the founders, and maybe because we're earlier stage focused, we're really, really focused on founders that understand deeply the problems and that are really committed to solving those problems, because the how is going to change. And if you look at the companies that have scaled, they have already internally pivoted kind of the operating model, moving from cash in to cash out to actual merchant payments, etc. And so you need to have that team that's really committed over the long term, because at Askya's level, we're focused on companies that can become those big techs that I mentioned earlier. So that means this is not a quick flip. It's not going to happen over 5 years. So the selection of the founder is actually the most important, because the right founders will have not only the good fit with the problem that they're working with, but they also will be able to scale with the companies. We have seen several instances where at one point the cap to the potential of the company becomes the founder, and when the founder is still a significant shareholder, how do you scale that business? Because we have not yet reached the stage where people put company before themselves, in the ecosystem at least. And one other capability that we see extremely valuable in Africa is founders that are able to inspire and partner up. Inspire, because you need to be able to attract talent in a market where talent is expensive and scarce. And partner up, because very few companies can operate in a silo in Africa. We don't have, SaaS businesses that can sit in their office, do online ads, and disappear. You actually have to work with a wide range of ecosystem, including government, like Tokunboh mentioned, and the ability to build those partnerships in innovative ways and solve problems, not just by paying money, but by being creative and aligning incentives between you, your sales force, your partners, etc., is a key driver of value. So those are the first things that we underwrite and we keep underwriting. On like the business model side and the kind of thesis side, we look at companies that drive digitization or leverage AI to boost productivity. The core theme for us is productivity, because if you're driving productivity for your customers, you're increasing revenue or decreasing costs. You have extremely strong stickiness in your business, and you're also driving value creation. So it's a self-reinforcing process. We don't invest in the theme of Africa's emerging middle class, because we think you have to first produce to make people wealthier to actually generate that middle class. There has been a lot of debate on that middle class. We think consumerism is not the key theme today, but we can get there if we create more wealth. And more specifically, what are the models under that we look at? We like hybrid models, which can come in different forms. It can come with agent-backed models that support the digitization to connect, whether it is to farmers or to small businesses or to people. It's also models like in EdTech, where you can have physical and digital training, because it reduces the cost and effectively increases the access. The second theme, which is related to AI and AI potential companies, we're looking at companies that generate vast amount of proprietary data. Because going forward, this is where the value is going to be increasingly. OpenAI cannot compete with you if you have exclusive access to all the healthcare records of Nigeria. They cannot have a better model than yours. And that's a case where we can actually build AI on the continent. Now, that includes companies that are already doing things in the healthcare space, or could be AI native companies. But we think digitization and that data generation are the two key things. And that's how we can drive, value creation.
Thank you so much, Babacar. I want to pause here. Derin, do you have any reflections to share? We're going to wrap up soon. We're running out of time.
Yeah, no, I think this has been a really interesting conversation. I think I love the long-term perspective. Our view, Osarumen and I, is one, we always want to take the long term, but we don't want to use that as an excuse. And so when we think of, 15-year venture cycles, we can't sit on our hands for 15 years and then, at year 15, look back and say, well, what happened? Right. And so we love to look at what are the signs that point to where we're going, whether we're on track or off track, and what are the adjustments that we need to make if we're on track to, go off. And I think lots of food for thought in this conversation. So really, really glad we've had it. Looking forward to going out for coffee with everyone on this panel at some point and even deeper on these topics. But this has been really fun to listen to. So thank you all.
Thank you.
Big thank you to everyone for taking the time to join. We've come to the end of the session now. Just a quick reminder to the audience, please fill out the post-event survey and take a look at the TechCabal Insights exits dashboard. This conversation was produced by TechCabal Insights in partnership with the Subtext and Unevenly Distributed. Have a good day.